Welcome to everyone tuning in. Thank you for joining us today. My name is Jillian Perkins. I'm the Director of Communications at Arnerich Massena, and I'm here today with James Ellis, our Senior Consultant. James has done some considerable research into how public universities may be able to stay funded and affordable in spite of massive decreases in state spending on higher education. And he's here to share some insights on that with us today. Before we start, just some quick background. Arnerich Massena is a Portland-based investment advisory firm. We've been in business for more than 25 years, bringing our unique and disciplined process and philosophy to nonprofit endowments and foundations, high net worth individuals and families, and corporate clients. James works specifically with institutional clients, including university foundations and endowments, building investment programs, and helping guide their investment committees. We recently published a white paper called Keeping College Affordable: How to Fund Public University Obligations in a Low Return Environment, which is available on our website at www.arnerichmassena.com. James, as a primary contributor to the paper, offers us some terrific solutions for public colleges as they look up to make funding shortfalls. So with that, let's dive right in, and he can share some of these solutions to keeping college affordable. So let's start by taking a look at the problem. James, can you tell us about why public universities are struggling for funding?
Well, thank you, Jillian. There's just a lot of demand for resources at the state level as it relates to taxes. K-12 education, corrections, police and fire, but namely Medicaid spending has been the single biggest contributor to the decline in higher education spending. There's just an aging population situation that's just demanding resources at the state level. Just to quantify this, overall state funding in 2017 was nearly $9 billion below the 2008 level in real terms. So $9 billion in aggregate at the state level, or at the nationwide level, excuse me.
Wow.
Just to further quantify this, that's a 25% drop in state spending per student from 1987 to 2017, again in real terms.
So that is definitely a problem. What about raising tuition? Is that an option?
Well, that's been kind of the other end of the ballast, if you will, with a decline in state funding at the state level. Tuitions have gone up. It's almost an inverse relationship.
Yeah.
So the average annual net in-state cost of tuition for a four-year state college student has doubled in real terms from 1997 to 2017. So that's a pretty big jump. 20-year period, we've seen a double in terms of all-in tuition, including room and board and the actual tuition itself.
Right.
In-state tuition and fees at the four-year public colleges have increased an average rate of 3.2% beyond inflation for that same 20-year period. So just to put that in perspective a little bit more there. Now, this increased tuition impacts the student body and opportunities, particularly at the lower income end of the spectrum. The students that basically need to go to college the most or could get the most boost in terms of their lifetime earnings just simply aren't able to do so as a result of this, or just may decide that it's just not a worthwhile investment. But another area where this shows up is in terms of the quality of education. Just less investments in terms of capital resources for the students to take advantage of as it relates to technology, classroom funding, quality of professors and things of that regard. So, that overall undermines the objective of the educational institution itself, in my opinion.
Right, that makes sense. So no more tuition hikes, but in the paper, you outline two main kinds of solutions. So let's start with the first one, which is fundraising. The first fundraising technique that you recommend is something called a corporate sponsorship. So what is that and how does that work?
Yeah, absolutely. This is an interesting solution that we found during our research into this paper. Now, what a corporate sponsorship entails is a local corporation, be it public or private, I don't think that really has a bearing on anything, will essentially help develop a curriculum that the students should then be taught in class. Now, this requires special education of the professors actually teaching the material. Sometimes there'll be investment in terms of, again, technology as it relates to software or computer hardware that's specific. So the end result is the student that comes out of this program has specific training to the corporation itself. So everyone benefits from this type of arrangement. The corporation gets highly skilled, highly trained employees that are specific to their needs in the workforce.
Right.
The students get practical knowledge and experience that has real world usage. And the school gets funding. There's often an opportunity for internships along the way as well. So the student has the ability to learn outside of school as well as inside of school. Now, there's a variety of avenues for these corporate sponsorships. Again, they could be scholarships, donations to the actual endowment itself, and also, again, endowed professorships and investments in capital resources for the institution as a whole.
Wow, so that does sound like a win-win. Everybody gets something out of it, the students, the school. Do you know of colleges that have used corporate sponsorships, and has it been successful?
Yes, absolutely. So we collaborated with a university in the Cal State university system. They are currently partnering with various local institutions within their community as it relates to finance, agriculture, engineering, construction management, computer science, pharmaceuticals, and chemistry. So they have a very well thought out, well defined process for identifying these corporations and taking advantage of, again, the synergies between the private community and the public institution. So, for instance, one of the examples I was provided was this particular university is located in an agrarian-based economy. So, instead of training, well, first off, the students get great training as it relates to engineering, as it relates to agrarian type of uses, but also financial institutions who specifically want to target farmers for equipment leases and things like that. So the financial sector also has an interest in training students for a particular population or demographic in the local community as well, which is exactly what's happening at this particular institution.
Right. Well, that sounds like a great solution. You mentioned another fundraising technique, which involves reaching out to school alumni also. Tell us about that and how that works.
Yeah, absolutely. So that's been something that the private universities have been doing for years. I mean, let's face it, the human capital of the alumni base is probably the largest asset of any educational
Right.
institution, since they've directly had an effect in building that particular capital. So tapping into potential past students is certainly a good place to start when it comes to fundraising. So alumni are another source of potential fundraising along with corporate sponsorships in that regard.
Right. So in the paper, you even provide some tips for how to reach out to alumni and do that successfully. What suggestions do you have for public colleges that haven't really done this type of fundraising before?
Yeah, absolutely. So, one of the key ways that a public institution can go down the path of fundraising from alumni is to make that emotional connection. There's all sorts of memories that I have from going to college that I'm sure everybody shares as well. So, eating at a particular restaurant, maybe a place where you met a significant other, or a particular professor that you like, or just the smell of a dorm room, if you will. So there's always that emotional connection to going to college.
Yeah.
So tapping into the emotional memories, the knowledge of the experiences you had at a particular institution is a great way to approach alumni. And each institution is going to be unique in that regard. I should say it will come with costs in terms of building a fundraising outreach program, and it'll take time to ramp up.
Yeah.
Now, just to put some statistics around that, studies show that a typical alumni outreach program can raise $1 for every 24 cents invested. So,
Wow.
yeah, absolutely.
That's some ROI there.
Yeah, no kidding. So some programs are have more optionality, if you will, than others, but just in aggregate, $1 for every 24 cents invested. So it's a good return on investment, like you say, Jillian. Another approach is don't be afraid to cultivate major donors. There's obviously going to be that cadre of successful individuals who were able to really benefit both themselves and perhaps the community. So cultivating those major donors is going to be crucial in any sort of outreach.
Right.
So again, it's important to tap into that emotional connection to the institution, but also answer why. Why would you want to give to this? Why would you want to donate to institution itself? Well, it's obviously to help the next class of students who will be the leaders in the community, who will be the ones who you will work with, or perhaps request services from at some point in the future. So answering that question of why is going to be important as well.
Yeah. Well, that is great advice in terms of fundraising. I want to switch gears a little bit now and talk about investment tips, because in the paper, in addition to fundraising ideas, you also provide some investment solutions, and this is really the key focus for us since we are an investment firm. But before we talk about the specific suggestions, in the title we call this in a low return environment, how to fund public university obligations in a low return environment. So what makes you say that this is a low return environment?
Yeah, absolutely. That's a great question and something I address quite frequently. So we are in a low return environment, meaning stocks and bonds, both collectively, when constructed into a portfolio, just simply won't be able to provide the returns of the past decades. Our internal research has shown that a diversified portfolio has declined from about 12% in the 80s to roughly about 5.5% today.
Wow.
Yeah, so that's a significant decrease in terms of what the markets can be expected to provide going forward. So that's what I mean by low return environment. Now, by and large, this is due to a variety of factors, a variety of headwinds in terms of the underlying capital markets, and one of them being unwinding monetary stimulus. We've gone from a quantitative easing from the Federal Reserve to now what's termed in the media as quantitative tightening. This all ended with the taper tantrum in about 2013. The bonds that the Federal Reserve was buying throughout the 2000s and early 2010s are slowly rolling off the balance sheet. Now this is monetary tightening, if you will. Along with that, we have a rising interest rate environment. Interest rates have gone from basically zero interest rate policy, ZIRP, if you will, in the mid-2000s to currently 2.25%. And the Federal Reserve is expected to keep hiking rates, possibly another time in December to 2.5%, and possibly 2 to 3 times more in 2019. So, so this does cause a headwind to interest-sensitive investments, namely housing, automobiles, and just consumer goods. So the consumer is, expected to face some headwinds in that regard.
Right.
Now we also have a demographic issue going on in that, we have an aging population, a population that is no longer earning income and, just kind of downsizing, if you will. So again, another headwind to the consumer. And, I should back up and say that consumer spending makes up about 2/3 of the U.S. GDP. So, the significant headwind to consumer spending is certainly going to have create headwinds for the economy as a whole. Now, along with that, we also have high valuations in the equity markets. Price to earning ratios, forward, current, past, however you want to slice it and dice it. Any sort of valuation metric you look at as it relates to U.S. stocks are currently, overextended. So that's another headwind to the causing the low return environment. Now, there's certainly opportunities overseas. But for the most part, U.S. stocks are a little overextended at these levels, if not fairly valued, just to be kind to the situation.
Right. So it's definitely a challenging environment for investors. So when you first look at a public university's investment portfolio in this kind of environment, facing these headwinds, when they're struggling to meet their objectives, what do you look at overall, first of all?
Yeah, one of the main things I look at, most not-for-profits have a perpetual time horizon, meaning they're investing, their timeline is forever.
Right, yeah.
So as a result, a lot of educational institutions and other not-for-profits can handle a lot of volatility. And with that volatility should come higher returns if the portfolio is properly allocated. So the first thing I look at is, are they invested aggressively enough? It's interesting. A study we outline in the white paper shows that it's always been difficult to obtain a 7.5% real return.
Right.
Or I'm sorry, 7.5% return in the portfolio, or 5% real spending rate. That's always been difficult.
Yep.
So going forward, that's going to be even more difficult. So. Investing more aggressively is certainly going to help in that regard, and being able to absorb the volatility that comes with that. Another area that I tend to review is the portfolio properly diversified? Is the mix of international to U.S. equities appropriate given global output and production? Are there alternatives in the portfolio? Things of that nature. Again, I alluded to the time horizon, but again, it's important to come back to that and just say that a college endowment should be invested with a perpetual time horizon and absorb the volatility that comes along with it. And in regards to that, it's important to minimize cash and fixed income holdings. Let's face it, with the 10-year currently about 3.1, 3.2%, that's roughly a real 1.2%.
Right.
It's going to be very difficult to obtain a real 5% spending rate with fixed income holdings. And cash,
Right.
You're barely covering inflation with cash. So minimizing cash and fixed income holdings is going to be paramount to obtaining a 5% real return going forward.
Yeah, that's a great point, a time horizon and perpetuity. So you also talk about active management, and how can this benefit a university's portfolio?
Yeah, so both active and passive can play a role. Again, I'll come back to U.S. large cap stocks. It's any piece of information is typically reflected in the marketplace. So it's a very efficient asset class, excuse me, so to speak. So there's just not much opportunity for alpha unless you take a concentrated approach in U.S. stocks. But nonetheless, active and passive can play a role. Now, active management does help in areas like emerging markets or international small caps,
Right.
where there's less information. Information is harder to parse out. There's less research analysts following the underlying securities. So active management can play a role in these less efficient asset classes. Now, another area that has some less efficiency is the fixed income markets. Intermediate fixed income is not representative of the entire intermediate fixed income universe. So there's certainly areas to add alpha in fixed income as well. So if you are to have an allocation to fixed income, we typically do recommend active in that particular asset class. So, there's efficient asset classes and less efficient asset classes. In the less efficient asset classes, there's just simply more opportunities for alpha.
Right.
And active managers can pursue opportunities and act defensively should we experience a downturn in the market. Active managers on the whole typically hold higher quality securities with larger economic moats, if you will, that typically do well in a downturn.
Yep.
So there is an opportunity to be defensive with active management. But to put it all together, active management risk is compensated risk if it is managed properly. So that's a key
Right.
takeaway I think I would want to point to for this discussion.
Right, that's important to remember. So I want to go back, you mentioned alternative investments. What do you tell your university clients about alternative investing?
So nonprofits have been increasing their allocation to alternatives, over the past, say, 30 years. There's empirical data, no shortage of empirical data that points to this. Public markets are becoming more concentrated. If you can imagine, Jillian, there was about 8,000 public companies in 1997.
Right.
There's now 4,400 public companies in the U.S., I should say. So that's a 45% drop from, over almost a 20-year period. Of those companies that are public, buybacks have become more prominent. So there's just less public stock available. So what that does is it creates more opportunities in private markets. And alternative investments are a good vehicle to approach those private markets. Now, alternative investments do typically provide greater long-term potential, particularly as it relates to private equity or illiquid partnerships. And when they're combined in the portfolio structure, adding alternatives in can often reduce risk with the same or even higher rates of return.
That's fantastic. So you also were talking about when you talked about the time horizon and perpetuity and being able to afford some illiquidity. And in the paper you mentioned the illiquidity premium. What's that, and how can that do something for a university's portfolio?
The illiquidity premium typically refers to the fact that a portfolio manager of an illiquid investment, be it a limited partnership or what have you, can hold on to securities through thick and thin, so they can absorb volatility as it relates to cycles in the underlying macro environment. So if for instance, if a portfolio manager buys a cyclical company, they can certainly wait it out until the end of the 10-year period or whatever period the partnership might be, so they can just absorb more volatility. I like to think of private equity managers as long volatility and short liquidity, if you will, whereas an absolute return manager may be short volatility and long liquidity. So you're getting the inverse of that through the illiquidity premium. But it's also important to say that liquidity comes with a cost, and illiquidity, again, can just simply bring a premium by design for investors who are willing to invest in illiquid assets. There's certainly opportunities in private markets for these types of investments, but it is important to construct the portfolio with liquidity needs in mind. I mean, you're not going to be able to tap into these illiquid partnerships without a great deal of friction, if you will. So maintaining liquidity in other areas of the portfolio and right-sizing the position is going to be crucial in terms of being successful with these types of programs.
Right.
Now, I will also point out, Jillian, that endowments with higher allocations to private markets have outperformed their peers over any sort of time frame that you want to try and imagine. There's plenty of data that point to this as well.
Wow, so this would be critical for a university looking to make up some of that funding shortfall, definitely.
Yes, absolutely.
So let's talk about risk and volatility for a bit. How do you construct portfolios to address some different risks?
Well, first off, Jillian, it's important to define the risk. That risk can take on various different types of categories, if you will, such as peer risk. Perhaps there's 10 or 20 institutions that a college university business officer is following that they want to outperform or at least perform in line with. You certainly don't want to be at the bottom of the pack when it comes to your returns. So there's a certain element of peer risk or keeping up with your peer group. There's also benchmark risk. Typically, when a portfolio is constructed, a portfolio benchmark is constructed as well. So you certainly want to outperform that benchmark, at least perform in line, but you definitely don't want to underperform that benchmark. So that's important when it comes to discussing risk. There's also liquidity risk, like I was mentioning previously. If you're too over-allocated to illiquid investments, you may face some sort of liquidity shortfall. So that's a risk that has to be included as well. Now, with investing in perpetuity, there's also an inflation risk. So investing in real assets, be it oil and gas partnerships, REITs, MLPs, inflation-sensitive securities to help overcome that inflation risk is going to be paramount. But I'll also say this, Jillian, there's a concept of maverick risk, or being too over-allocated into a certain asset class and then not having that bet, if you will, work out. So there's a certain element of maverick risk as well. You don't want to, well, if you are different from the pack, you better be right. I guess that's what it boils down to.
It's a good name too, maverick risk. Well, that is fantastic, James. Some really great advice both on the fundraising side and on the investment side. Do you have any final thoughts that you want to give to public universities working in this area?
Absolutely, Jillian. So when it comes to funding the shortfall and decreasing taxes coming from public state coffers, it's important to maintain a long-term focus, building out fundraising strategies, corporate sponsorships, investing the portfolio into an investment profile that's more in line with a perpetual time horizon. These are all very long-term type of goals. So, devising 30-plus year plans in that regard is going to be important. Maintaining a long-term focus, I can't stress that enough. It's important also to craft a disciplined investment policy, again, that defines those spending goals as well as risk tolerances and any unique needs the institution may have as well. It's also important to rebalance, have some sort of rebalancing policy, be it 1 year, 4 years. And that's not necessarily, Jillian, to increase returns. It's more to reduce risk in the portfolio. So a disciplined rebalancing policy is always needed as well.
Yep. That makes sense. If the university wanted to reach out and talk to you directly to learn more about this or to actually get help from you, how would they reach you?
Well, Jillian, my email is jellis, JELLIS, @am-a.com. So certainly email me there, or my phone number is 503-239-0475. Anybody is able to call me there as well.
That is fantastic. So please feel free to reach out to James if you would like more information or his help directly. And I want to say a huge thank you to you, James, for sharing your insights today. You can visit our website to read the complete white paper, Keeping College Affordable, How to Fund Public University Obligations in a Low Return Environment, at our website, arnerichmassena.com. And thank you so much for joining us today.
Thank you, Jillian. This was fun.
Thank you for listening to Arnerich Massena's podcast. Please see the podcast description for important copyright and disclaimer information.